joining us to help us take a look at this number, the Treasury's reaction to financial markets. And, well, Alan, welcome. Thanks for joining us. It's been a while since you've been on the Future Show. Always a pleasure. Let's talk, first and foremost, PPI yesterday, CPI today, both coming in higher than expected, kind of feeding into the narrative that some of these stimulus measures could bring about, spark some stimulus.
Right. Well, that was their intention. They were looking to give a little bit of a spark to the markets. And what we saw in Treasuries yesterday was the beginning of something. You know, the rates were ridiculously low, and you could see there was a bit of a, unwind yesterday. So these markets have been trending, in their directions for months and months and months. And you can see what happens when the trend changes and everybody runs for the exit. There was a big move yesterday. So let's look today, like you said, you already showed the chart that its continuation is following through on that. So, maybe there's still some more upside here in yield, but I think that's part of the intention of the Fed is they're trying to spark inflation. And, just like they said a long time ago, they wanted the dollar down. They finally got what they wanted there. So you can't say no to what the Fed says they're going to do.
We're looking at rates here. We just took a look at the futures a minute ago on the 5-minute time frame. Now we're looking at rates. Again, we talk about the inverse correlation. Futures to the downside ultimately mean rates to the upside. Right. Here you can see the 30-year yield on the left up to 1.38, Alan. TNX to 0.69. How concerned should we be if inflation starts to become, well, something that they've wanted it to be, again, to certain levels, not necessarily, I guess the concern would be if it starts to reach runaway levels. I mean, ultimately that can weigh on the indices.
Yeah, in the long run, it possibly could. But look at how low rates are. And, I don't expect that to change anytime soon. The reflection you'd also want to look at is gold. Now, yesterday was a expected, let me say this again, expected unwind. We didn't know when. It wasn't a matter of if, it was just a matter of when there was going to be some selling pressure and some unwind and everybody's going to run for the exits in the gold market. Now, let's see how things react. That dip last night below 1900, that could, and that comeback, that could be capitulation there. It's not over in gold. You just have to see that everybody, took some profits yesterday and the ball got rolling. So we had some trend changes yesterday, but it didn't hit the other markets. It didn't hit the equities, which have been straight up for 6 months now. Yeah,
for the most part. Certainly Russell, the Dow recently, the Nasdaq giving up a little bit of momentum over the last few days. But let's talk about some of those trend changes that you just mentioned. One of them, which you and I have talked about a lot over the last couple of years, was the dollar's disconnect from rates. It does seem like recently, though, it's a little bit more tied to the rates. It started to come off. You mentioned the Trump administration talking it lower, whatever you have, forcing it lower. It did come off recently down into the 93 handle. We saw rates coming off as well at the same time. Should we expect that trend to continue, Alan?
Well, I'm looking for the dollar to continue lower. You can see yesterday there was a very, very modest bounce in the dollar, and that was not the reason that gold sold off. Gold sold off because of profit taking there. So there wasn't that normal correlation between the dollar index and gold. It was not because the dollar was rising. But if you look in the bigger picture, the dollar's been between 104 and 88 for 5 years. So 96 is an important pivot. So it's been straight down since we went below 96 in that dollar index. And I'm looking for that to continue there. If you look at all of the other currencies, if you haven't been long, you've been wrong. The Canadian dollar, the Australian dollar, the euro currencies, all had absolutely straight up moves where they made complete V recoveries and made new yearly highs. So there's still a lot more upside in that euro currency. If you look at the euro currency in the last 20 years, it's been between 80 and 160. So 120 is the midpoint over the last 20 years. Right now, we got above the 5-year midpoint at 115, but I still see more in that euro currency. And again, let's not doubt the politics of these markets. That's been unfortunate for those people that did not believe that the politicians are going to do what they say they're going to do, and they say they're going to weaken the dollar as a stimulus, and that's exactly what's happening.
Yeah, euro currency up into the 119 handle. I said dollar to the 93 handle. I meant to say the 92 handle. Actually traded down to 92.47. All right, Alan, we've got CPI, we've got PPI came in a little bit higher than expected recently. The jobs data came in higher than expected. This is a little bit of a shift in terms of some of what we've been seeing, because it seemed like for a few weeks after the reopening started to occur, U.S. data was coming in better than expected, but then European data started to beat. We got the European stimulus measures.
Now we've shifted.
That boosted the euro currency and kind of have added to that sort of, kind of narrative of a more consolidated effort on their part to sort of stimulate economies there and a more form of solidarity in many ways, people called it. But recently, we've shifted back to where we're starting to see some of the economic data here in the U.S. beat. Can we expect rates to continue to go higher? You mentioned how you think the dollar could continue lower, but if this economic data continues to beat, in theory, we could see a trend change here as well as far as not only economic data beats, but also how the dollar responds to some of the data.
I'm never the guy that tries to pick the trend change. I'm older than that. I've overcome that temptation. Look at the Euro trend. The Euro trend went from 107 to 119 straight up. Yeah, now we've taken a little bit of a pause. But even with the negative numbers that they had out of the UK, overnight, it's holding pretty well, as is the Euro currency. So again, you want to see not how they act, but how they react. And the reaction has been very, very minimal. Again, I'm not one to pick the turn or the tops in any of these markets. I'm still a big believer in technicals. And you've talked extended about the crude market. I think the crude market could be the next catalyst as far as to the upside, because it's within that range, looking for that to break out. It did fill that gap from February. That's a pretty amazing gap, and it's above the midpoint of the action for the year, and it's been holding steady. It's been kind of the last of the major assets that hasn't made a runaway, move yet. Now the key is yet. So I think crude is going to be a benefactor here. But we talked here about the Canadian dollar, Australian dollar. Those are commodity currencies, and those have gone absolutely positively straight up. And so we want to see how they continue to follow through on this positive action. So I'm still a trend guy until proven otherwise. But you've got to look and see how they react when you get a pause like that. Gold move was incredible, and now it's shook in the tree a little bit. Now the markets have to do that. They have to have that FU move, that financial unwind, before they make another move higher. And let's see what the next leg is in those markets.
Well, we'll look for that financial unwind, as you put it. And let's talk about, I actually have the chart up, crude oil and, as you mentioned, Canadian dollar, a couple products that have certainly benefited from a weaker dollar. Alan, really appreciate you joining us here. That was a great breakdown across the board, talking CPI, inflation data, the impact it has on us as investors and some of the products that are on the move in reaction to. Alan Nuckman, ladies and gentlemen, check him out. He's the chief market strategist at Agora Financial. And now that we've covered the fundamentals, I want to dive into some of the technicals. And ladies and